Yeah, I guess good afternoon, everyone. We have the distinct pleasure of being the last panel before drinks and right after, no offense, compliance. So I guess that's what a bronze sponsorship gets you these days. I will say, I think as we all know, liquidity is the absolute lifeblood of everything that we do and everything that we're involved in. And this panel right here are the experts in liquidity and liquidity management. So I would absolutely ask you all, put your attention up here, give them your time, and please ask questions along the way. I have the distinct pleasure of at least announcing the panel, and I will just provide some bios real quick. First, Ethan Kahn. Ethan is a principal at Wolverine Execution Services, has a deep expertise and in a wide array of index and derivative markets, from algorithmic trading to index arbitrage, and even uniquely weather derivatives. So plenty to do and understand there. I actually want to know how weathermen actually get a job, just picking sort of anything that they want, but we could talk about that offline. Next, we have Naomi DePina. Naomi is a managing director at GTS Securities. Naomi has a tremendous depth of knowledge and experience across trading, structuring, and distribution, advising clients across ETF selection and optimization strategies. Dare I say, Naomi is a woman for all seasons. No joke there. Okay. Chris Hempstead. Chris Hempstead has already introduced himself. Chris is managing, definitely a golfer. First birdie, by the way. I don't know. Tell you about the other 17. Yeah, fair enough. Breaking par, I'm sure, on all of them. He's a managing director at Murray. Chris holds a wealth of knowledge for global managers in navigating the ETF landscape and can speak to seamless launch and ongoing ETF management. Finally, last but not least, Josh Khalif. Josh is an institutional trader at Flow Traders, responsible for the lead market making business. In addition to block trading daily for institutions, Josh focuses on the firm's growth initiatives, including fixed income and digital assets. And also uniquely, Josh is our resident professor on the panel. So no worries, there will not be a test afterwards, or there might be. So leave now before you are being asked. Just kicking it off real quick. I think one of the unique angles for each of these panelists is really the trends they see every single day in working with issuers. And Chris, if I may just turn to you, and if you wouldn't mind starting us off, what are some of the unique trends you're seeing in the ETF space? We've heard a number of them already launched today. And how do you see those trends either increasing or potentially changing?
I think, obviously, we've seen a tremendous growth with options-based strategies, if you want to call that a trend. Creativity with flex and defined outcome strategies, that's certainly here to stay. But I think the trend is really a lot of innovation. I think we're definitely seeing a lot of products come to market that require non-traditional assets like swap, flex options and things along those lines. Some even with illiquid or private assets, and we catastrophe bond ETF, right? So innovation, I think, is the trend, which has been the industry's friend for a number of years. And I'll speak for me. I don't think I'm smart enough to know what the next creative idea I've never heard of is going to be. But I think I speak for everyone. We're all ears. Bring it to us. If you think you have the next best idea, interview us and talk to us about how we might think about that from providing markets on exchange. And I think all of us have collectively been resilient to ideas that we know nothing about, and we just figure it out.
I think we totally figure it out. So, hi guys, I'm Naomi. Nice to meet some of you. We are going to make this panel, I think Chris and I were joking about this earlier. We're going to make it as brief and as exciting as possible because we know that we're standing in the way of drinks. We even thought about bringing a drink up here. But to answer your question, Tom, I think a lot of the same comments Chris just mentioned, flex being definitely top of mind as issuers want to define their own outcome and define their own risk, essentially. So we're hearing a lot of flex. Options-based ETFs, I would say, has been a trend since 2024. People always say active is not a trend. 48% of the launches actually last year were active ETFs. So I think that trend is no longer considered a trend. The other thing I would say is private securities within ETFs. So we saw a couple of launches, State Street being one of them, ER shares being another. A lot of firms are filing for private securities within an ETF wrapper. So I honestly think that's really cool, and there's going to be a lot of growth there.
Yeah, making markets in private securities. That's going to be really interesting, won't it?
Yeah.
Ethan, how about for yourself?
So Chris, I think the next big trend is weather derivative ETFs. That's why I'm here. No, I will second everything that's been said. I'm not going to bring up mutual share class. I think we've heard a lot about that. I'm sure it'll come up again. But 351 exchanges have been a big trend. A lot of questions. I don't know, there've been maybe a couple hundred issues so far, but I have to say it's probably one of the top questions we get in terms of, can you help us with this? Now as market makers, we're not involved with actually getting that 351 off the ground, but we're very involved in what happens to that ETF once it is issued and what needs to be done to get it from A to Z. But yeah, I think the derivatives and ETFs, which is kind of Wolverine's focus, has been just a huge boon. I think NASDAQ just recently put out a piece showing a growth from I think it was 2020 of 5 billion or so of ETFs with options in them, whether they're defined outcomes or just income enhanced ETFs, to 160 billion in 5 years. So it's been a tremendous growth. So we're continuing to see that, and as Chris said, there's constant innovation out there. We're asked for what do you think of this portfolio or that portfolio? One thing I think we all do as market makers, which is not discussed as much, but I think it's a huge value added to a lot of issuers and advisors who come our way, is, hey, take a look at this in advance of getting, instead of calling us 2 weeks before the launch. Hey, what do you think of this ETF? Where would you price it? What would your bid offer be? How would you hedge it, et cetera? We would be more than happy to talk about that in advance. I think that helps in the process quite a bit.
And I'll add on, the one thing that we've certainly seen in a lot of the trends that the panelists have mentioned and that we've talked about in historical panels, we're seeing a lot of that now kind of wrapped up and moved over to Europe. And back in the day, people would always be like, oh, Flow Trader is a European firm, let me talk to you about Europe. Now people are actually like pushing that a little bit forward, and people are actually going out to the region, learning about the market structure, hiring the right capital markets and sales folks to distribute it. So it's all to say that a lot of the innovation is starting here in the US, and then a lot of it is kind of getting globalized. And we're seeing that occur on active funds, of course. We're seeing that in the defined outcome products. And obviously being a European domiciled firm, we're seeing a lot of those launches take place that used to be in the US, but are now kind of being replicated over in EMEA.
The other thing we didn't touch on, and I'd be remiss not to call out Krista from Grayscale. I mean, they scream innovation. They scream digital assets, Bitcoin, Ethereum, and all kinds of different variations of that. There's no end in sight. And then the other thing we didn't also mention was, look, we'll call it 24-hour trading, but let's call it what it really is. It's access to the markets between 8 p.m. and 4 a.m. And that's here. It exists now. And there may not be a lot of demand out of the US, but there certainly is out of Asia. And is it as much as the US market volume? No, not even close, but it's here and it's not going away. So, that's a trend that we're following very closely. I don't think any of us want to work 24 hours a day, but seems to be, gravitating towards that.
I think tokenization is huge. We did not touch on this, so thank you, Krista, for being here. But the other part of it too that we really need to focus on is the ideas that have been launching have been more and more specific, right? And so almost a lot of what we get approached with, and I think everyone can attest to this on this panel, is everyone thinks they have the best idea, right? And then sometimes there's 4 of the same ETF. So talking to clients, not 2 weeks in advance, but maybe 2 months in advance of, does this ETF have life, right? And considering that, and is it just a trend or is it viable in the market? So that's a big consideration.
That's a great. Let's just stay on that topic for a second here. What are some of the challenges you see from these trends, from this growth, right? Is there concentration? Are there that you're dealing with on a daily basis. Maybe Ethan, if you could take us out here a little bit and talk about some of the difficulties you need to overcome.
Right. So it's actually on the number of fronts. So just quick step back for Wolverine. So I actually represent both. For many years, I was on the Wolverine trading side. So I was a lead market maker working on actually the ETF trading. And the last couple of years, I've moved over to the WEX side, which is execution only, agency only, and where we work with the issuers directly and help execute the baskets with portfolio managers and such. So it's been great having kind of that knowledge and understanding of what happens on the LMM side to be able to work with the portfolio managers and give them a kind of an inside look of like what to expect. But I'd say the biggest challenges I'd say would be two. One, with these defined outcome funds, and a lot of these funds that all have chosen month ends to roll over their baskets. So a lot of them have 12 monthly annual ETFs issued every month in the 12-month series, and there have been, I don't know, a dozen different firms doing that. The AUM on these has grown quite a bit, and when the rollovers occur, groups like WEX, we're going out to the for an RFQ to the same group of market makers to roll over literally all the same SPY or Q options on the same exact day, and it's only getting bigger. And that liquidity, I don't think it's a problem at the moment with the indexes that are being traded, but people are talking about doing them, and where obviously Bitcoin has also started these defined outcomes, but they're talking about doing these defined outcomes in single stocks, and also the single stocks that have also monthly rollovers. The liquidity is going to become a concern. It's already concerned on the single stocks, but it's an issue I'm worried about. And the other one is the SIBs. We've talked about, other panels have talked about it, but the capital requirements among the market makers to help with the custom in-kind creations and redemptions, especially with the mutual fund share class coming on board. It's only going to become a bigger problem. I think everyone on this panel talks about it every day, and it's something that the industry is going to. We're going to see a lot of innovation, I think, in that space.
We tell issuers, prospective issuers, existing issuers to think about capacity, not only in your strategy. If one of the earlier panels talked about position limits and things like that, that's a capacity, finite number, and that moves around a little bit. But I mean, that's something they need to be thinking about. Or if you're in a micro cap strategy that's very focused on a particular sector, you might not be able to put $1 billion to work in a week without really disrupting the market. So you have to think about capacity in your strategy. The other thing we always like to remind them about is, look, the ETF industry, we all know that why we're here, is growing every single year. It's awesome. It's a great industry that we're all in. But the number of participants that support it is not growing as fast as the industry is. There's 4,200 plus products now. 98% of the assets are probably in the top 750 or 800 products. That leaves a lot of products that have room to grow, and they will. I'm certain of it. Maybe 15 years ago, that number might have only been 150 products. So we're seeing it happen. And to the point of doing some trades, or whether it's a big block trade for an institution or a model, or whether it's a big rebalance trade, balance sheet at the banks and at the broker dealers is not growing at the same pace of our industry. So you really need to be thinking about, when you're asking for it, what you're asking for and what it costs to ask for it. Because you've got a lot more competition today asking for balance sheet than you did 5 or 10 years ago. A lot more. And the people that are figuring out how to pay for it are the ones who are getting it. They're at the front of the line every time. And there's no doubt about it.
Agreed. And I think going back to Ethan's point earlier too, the biggest question when it comes to Flex, for example, and also just in general, launching these types of ETFs is it the right fit? So the question that I've been asking issuers a lot is this the right fit for you? Or is it more so a craze right now if everyone wants to have the option? So a lot of people are putting in their prospectus the ability to have Flex, right? It doesn't necessarily mean you need to go out and have Flex day one in your product. You can also many of the times use listed options and have that increased liquidity pool when you need it there, and eventually transition over your strategy into a flex option. So is it the right fit, or is it just because the other issuer that you're competing with is doing it? Is how I think about it.
Fair enough. Anything, Josh?
One other point about the lead market making side of things that I don't think always gets that much attention. Of course, there's capacity strains on balance sheet and just general like participants in the lead market making space. But the one thing that doesn't get a ton of attention is like the actual time and effort that goes into, taking on a new lead market making product and being ready to quote it on day one. I can obviously only speak for flow traders, but when we take on a new lead market making obligation, it requires multiple teams across the firm to all be ready on the same day. It requires compliance to be ready. It requires our risk team to have risk set up. It requires our RFQ system to have the proper parameters so we can quote a block should it come in. It's one of those things that, it's very hard to quantify, and it's not something that's often talked about. But someone's like, oh, can you just put up 100 shares, 50 basis points wide and we'll call it a day? And like the answer is like, yes, that's obviously not the way we want to approach the situation, but it's also one of those things that to get up and running on a product requires kind of a full scale orchestration across our US office.
Can I comment on that?
Please go
Thank
for
you.
it. Yes.
So 100%, I think the points that Chris and Josh are mentioning are critical, because when I go to most meetings and I ask them, they ask, what does a market maker do, right? We are constantly there. We make a commitment to the exchanges to show up every day. We can't go on break, right? We've signed a contractual agreement. So many of you in this room, and I was on the issuer side for the beginning of my career, you pay for services, right? So the market making community is a little bit different, where we look for something where it's a reciprocal relationship. At GTS specifically, we're willing to work in most and many markets. We've expanded our asset class coverage, which allows us to transact and provide liquidity in these markets. But there's always a cost of capital, which is becoming more and more sought after for our balance sheets these days.
The other thing I was going to say was on that the market making side, you have to think about I mentioned the assets being highly concentrated in the top 750 to 1,000 products. So the obvious thing you should be thinking about is, oh wow, 3,000 products make up less than 2 or 3% of all the assets in ETFs. In the volume space, in terms of notional trading volume on any given day, it's the same. It looks about the same. I think 3,000 products collectively make up about 2 or 3% of the notional trading volume in ETFs on a given day, which could be 150 to 400 billion dollars depending on the day. This is important. A lot of people think that we make money on spread, right? Oh yeah, market makers make all their money on the spread. It's so easy. Yeah, those 3,000 products that make up a very small percentage of notional trading volume do not keep our lights on. They actually cost us money. They cost Josh money. They cost Naomi money. They cost Wex money. Me too a little bit, because I'm not as big as them. But but it's a real cost. The computers cost money. The risk costs money. The people that you have to have, the engineers, the developers, the traders, all of those things are a cost that we have to keep the lights on. So to Naomi's point, you need to be thinking about how you're getting that service from people, because I don't think any of us really have infinite capacity to provide it.
Okay, that's actually a really interesting point. Naomi, you mentioned a little bit about a reciprocal relationship, right? The ETF landscape is a host of providers, service providers, whether it's balance sheet for institutions like myself, balance sheet for institutions. How do you work with sort of an array of different service providers to have those reciprocal relationships? And what's best practices that you see for ETF issuers?
I think that was my favorite question you just asked.
Oh, nice.
So, okay, so my job is a little different than the gentleman on this panel. So I focus on relationship management. It's where I've spent most of my time, and I think relationship management is not only sales. So when people phrase your job as, oh, you're doing sales, it's not that. It's really being a consultant to your customer and to your client. And we want to consult and we want to work together. What's interesting in the market making community is that when we're working with an issuer or we're working with an asset manager, we want to consult you on the best way to launch your ETF. We want to consult you on the best way to trade that block. We want to consult you on the best way to RFQ and who you should look at. I think that many people in the first few years I had at GTS, thought that we were making money on spreads or figuring out some way to make money on the back end. If we were able to do that, I'm pretty sure none of us would be sitting up here, right? And so what we do best is when we work with a client and they have a demand and maybe that solution doesn't necessarily exist, right? how can we create that for them in a customizable approach? That costs money. We've hired over 11 engineers in the past year and a half because the industry and the market is getting faster. We need to automate as best as we can to deliver that consultative approach. I like reciprocal relationships. I prefer them. So when a client says, how can we also help you? That's music to our ears.
Yeah, I just want to add to that. Exactly right. And we view every relationship we have as we're a partner. And our job is to provide all the capital market needs for that issuer, whether it's on Wolverine trading on the LMM side, whether it's execution and providing RFQ capabilities and flex options, et cetera, on the WEX side, providing capital for the customs, advice on their ETF and the baskets, whatever it is, we're looking to work with them. I know there's a lot of issuers out there who kind of are everything to everybody. We've focused on what we're really good at. So, U.S. domestic option-based derivative strategies, that's our specialty. That's what we do well. Wolverine is one of the top option market makers in the country. And we use that expertise and provide a lot of that expertise to whoever we work with. So it's really important to view it as a relationship. And being the LMM is one piece of it. It's not a lucrative piece at all, but it's an important piece, and it's part of a larger relationship. And I think almost everyone on this panel would say that.
And to Naomi's point, about the kind of consultative approach and kind of being a product expert, we've had to almost tailor our business and the certain trading desks that we operate to make sure that we're able to satisfy the demands of various ETF issuers. A really good example is that we kind of when we were first starting trading the Bitcoin ETFs, we kind of just put it on our alternatives desk because it didn't have a great home. It kind of fit in there in that bucket. But as these products came, development got more complicated, the assets piled in, there was much more need from an LMM perspective. We actually had to spin that off entirely and now have kind of crypto ETP experts who sit on our trading floor all day long, and all they do is look at the various crypto products that are in the market. And it's all to say that all these different trading firms are looking to satisfy the needs. And one way we do that is literally changing our business operations to make that a potential outcome for our clients.
And I just want to add to Josh's point. I think that's excellent because a lot of what we do on an LMM side is we want your product to grow, because if you grow, we grow in the trading volume and we can be there more efficiently. I would say a lot of firms, and probably they do this to you all as well, is you can leverage us as capital markets experts on calls with the end advisor, right? So you as the issuer may not have a designated capital markets person. I think this is more and more important as ETF share class comes down the pipe. But many people do call our desk to say, hey, Naomi, can you talk to our client about this fixed income trade? And I'll loop in our specialist. So leveraging us with your end client also makes sense.
Makes a ton of sense. Just want to move back a little bit in terms of the products themselves and the growth that they actually have. Given that, thematic and levered ETFs growth, as Chris was mentioning, went from 5 billion to 160 billion over a few years. The concentration, the volatility. Oh, sorry, that was Ethan. I apologize, Ethan. Chris, it's always you. That's right. How do you approach that potential elevated volatility? How do you approach the idea of a success for the issuers and potentially success for yourselves is out actually reinforcing greater stress on that volatility, on that momentum, and actually potentially in concentration?
I'll be quick on this and let everyone else chime in. But one of the questions I always ask is, all right, where are the assets coming from? Do you know where they're coming from? And I think all of us ask this question because the idea of if you build it, they will come is just, yeah, it's a great idea. It's a great pipe dream in a sense. And once in a while, an ETF comes to market that's novel and new, and it actually gets traction and is a leader in its space, and it's here forever. But the majority of ETFs, you better have a good distribution plan. You better be thinking about where your core assets are going to be so you're profitable. Make sure you're over your hurdle rate in AUM based on your fee structure. You don't want to run it at a loss. I mean, these are important things to consider before you come to market. The other thing that we'll oftentimes advise on is that we're not a distribution team, and we're almost not, you have to come up with the idea. You have to come up with the product and figure out how to sell it. We'll be there for it. And then and I'll try to wrap it up right now. So we'll tell people when they come out, we'll give them indications on what we think the spread might look like on a particular sample portfolio that might come to market in an ETF. How much liquidity there might be on a 1 million or a 10 million or a $50 million trade, how much that might move the market. We try to give you guidance on that so that if you think those things are going to happen, you're not surprised by the outcome in the market. But most importantly, what I like to drive home is get to know your product once it's launched. Look at the markets from 9:30 to 4 o'clock. Learn what's normal. Expect spreads to be a little bit wider at 9:30. Expect them to compress throughout the day. It's just a natural, whether it's a stock or an ETF, it's just how it works. So learn the normal spread and the normal sort of cadence of your product with the market. And if you're talking to an advisor or a whale or whatever it is, and you pull it up and it looks 3 or 4 or 10x wider or different than what you're expecting to see, hit the pause button, pick up the phone and call your capital markets person or one of us or someone that you have a relationship and say, hey, can you take a look at this? Because it doesn't look normal. It's normally 3 cents wide and today it's 30 cents wide. What's going on? We may have a great answer. It could be something's halted and there's a big news announcement. It could be there's a Fed announcement coming up that nobody's really sure which way it's going to go. There's a number of things that come into we might have a computer glitch, like where we're just resetting the system and it takes 30 seconds. It could be any number of things, but learn what's normal. And if you see something abnormal, stop what you're doing. You've got time, pick up the phone, ask questions.
So regarding the leveraged and thematic ETFs, I think there's a couple. I know there's some people in this room who are directly involved in some of those products and know this probably better than even I do. As these keep growing and you're seeing, NVIDIA, MSTR, Google, Apple, et cetera, single name ETFs, leveraged, inverse, et cetera, just growing. We're in the billions in some of these names. And the market's up huge. That they are, at the end of the day, a lot of these products are using swaps, or if they're not using swaps, they're doing a market on close options that they need to leverage whatever that movement was that day, which is probably why you shouldn't be surprised when you see a big update to see a big uptick at the close of the day, because there's additional buying that needs to be done. So there's a lot of impact of some of these names, and I think we're going to see that grow. And I hear there's a certain number of market makers out there who provide the liquidity on those names. Obviously, a certain number of banks on the swap side, but the banks also have to go in the market to hedge themselves. So we're going to see some pressure on that side, I think, on these leveraged names. And then flipping over to the market maker side, think of the market maker now. He's making a market in the ETF that holds these leveraged products. Obviously, the inverse buff, to the extent that there's inverse on the same names, that does reduce it a little bit. But most of the assets are on the 1.5 or 2 times, not the -2. And the market makers also have to figure out, okay, how are they hedging this at the end of the day? And they're delta hedging it during the day or at the end of the day. So you're seeing a lot of, I think, market impact from some of these ETFs that are coming out there. It's not huge right now, but it's something to watch out for as it keeps growing and assets keep growing.
I would just quickly add to that. We've seen a lot of these launch. Obviously, we're lead market maker in quite a few. We love them right now. I understand the concern, and I do think that it is going to become more in terms of an impact concern in the future. I think there's a growing demand, especially in Asia, from what we've seen. Direction is a fabulous example of this. They've launched products. They've done very well in Korea and Japan, but also Korean issuers are coming to the U.S. to launch similar type of products. So that trend is extremely interesting to me. Matthew Tuttle and Firm, single stock, very interesting, and we're going to continue to see more of that.
And then the one other thing is that a lot of these levered ETFs, they're not inherently difficult to market make, right? And like in its most pure form, it's just 2x the stock. It's the fringe scenario where either there's a issue with the basket, there's an issue with the swap file. A lot of these things aren't uniform. So when they hit our systems on a daily basis, sometimes it comes in, the way you expect it, and you can read it into your systems and price it appropriately. But those fringe scenarios, sometimes it's like totally not what you expect, and in which case you need to spend a lot of time figuring out how to reprice the product, make sure you can provide proper liquidity, make sure you're not misquoting the product. So it's really those fringe scenarios. And then obviously when there's capacity issues at the fund level and on the swap provider level, when we need to be ultra cautious and when we spend significant amounts of time like looking at these different products, figuring out how to price them, working with our distribution team in APAC, who's dealing with a lot of the clients that Naomi mentions, because that's where we see a ton of the flow is, our office that's based in Hong Kong, who's trading with a whole litany of different types of end ETF users who are, becoming more and more accustomed with these 2x levered products.
So the other thing I just want to add, and that's, I think one theme you're seeing here is, we're presented with challenges as market makers, and we figure them out. And one of the other things is on the execution side, there's so much technology that has gone into the way we execute, with the way, you're going to multiple market makers at the end of the day, most of the time on hundreds, if not 1,000 names. And you're within, let's say 30 to 40 minutes, you're getting all these quotes back and going back to the issuer and picking the winners and maybe doing delta adjust on close. And that if that is not all automated, there's no way the market makers will even respond to you on the basket side. And you're just never going to get that done. It's only maybe 4 or 5 years ago where all that was done manually. So a tremendous amount of technology has been spent to make that process work and work, really well, including and especially using Flex.
No, Josh, you just mentioned a little bit about the fringe scenario when dealing with some of these alternative products, whether it's leveraged or options based. What unique risks are coming to your desktop when you're thinking about these fringe situations? Where do you see potential, I would say, concerns when dealing with a situation that might all of a sudden pop up out of the blue that you're not thinking about? How do you price that up, and how do you think to stress that?
It's really when there's immense demand, when it might be from an earnings release, it might be from retail exposure. And really it comes down to like those last 5 to 10 minutes of the trading day where, you'll see significant impact on the underlying stock, which will ultimately feed into the ETF and the NAV price and how the swap will ultimately be struck. Really, it's being hyper cognizant around the close from a pricing perspective, and then just kind of being agile and being aware of like how that's ultimately going to feed into our systems and ultimately how we're going to price that risk.
Makes a lot of sense. And as Chris, you mentioned it, as these products become more engaged really from a 24/7 market making platform, when liquidity starts showing up, when you have buyers, investors from Asian markets that are closed, how does that impact the liquidity market making or the liquidity and the market making of these products? And how do you think about it to actually engage something that is 24/7 now?
Well, I mean, from an ETF perspective, the most popular names in the overnight session are pretty household. It's S&P, QQQ, Russell, and then some single stock leverage stuff. There's liquidity there. I mean, look, if there's light liquidity and not a lot of price discovery, you could expect risk markets to be a little bit wider, and they should be. There's no reason for Josh or GTS or WEX to sit out there and make the market, super tight when the market doesn't support it. So just again, it's getting to know what's normal and being able to defend it. From our perspective, I think, look, if we're making a market in an ETF and it's a new ETF, it's a great idea. You're going to go out and do this big marketing campaign. You're going to get on CNBC and Fox Business and all these other things. Make sure you kind of tell people what you're doing. Give a heads up. Watch. I mean, we're doing a marketing campaign or whatever. It should be public. You never want to ever share non-public information with a market maker, because basically that means we can't make a market, right? And then now you don't have a market maker. So, but be thoughtful about that, because I think every one of us up here, if you launch a product that's averaging 2,000 shares a day, and it's really easy to make a market in it because we're a good partner of yours, and then all of a sudden, like blink, you get 5 million shares to buy in 100,000 different lots. We're probably thinking we're getting run over by someone. like we did something wrong, or we're missing something. So the first thing we're going to probably do is widen out, and try to figure out what we're missing. All of our teams are going to look at their computers and try to figure it out. I mean, that's a fringe case. It doesn't happen very often, and it's not a comfortable experience. But then you might look up at the news and be like, oh, guys, this guy's talking on the news. That's what it is. And then we'll come right back into the market. We'll tighten it right back up again, and everyone's happy. But it's just surprises, I think, in the market making world are not fun. We don't like surprises, whether it's your fault or whether it's something that, the President Trump might say periodically or put out on his, on his feed online. I mean, he tends to move the markets. We don't. Sometimes they're great opportunities for us, and we enjoy them in that perspective. But I don't know if we'll ever get comfortable with that.
It's not always glamorous.
Oh.
So just thinking a little bit, we don't have much time left. I want to leave some time for questions, but we talked a little about some of the trends, but thinking out a little bit further, what do you think the future holds, both for the market making business and for ETFs? I know we said a little bit we can't foresee the future. I totally understand that, but 24/7 markets, you mentioned obviously tokenization, fractionalization. What do you foresee, at least some of the really interesting ideas that are really gripping this space?
I'd like to see. Look, I mean, I think we're just going to keep doing what we're doing. I think, like I said, I think I said we're resilient and we're adaptive, and I don't think the concerns about capacity, as much as we air them out, are going to fall entirely. We're the ones that are saying, hey, look, be thoughtful about how you ask for capacity, right? We're going to solve for it. Like if everyone else is trying to solve for it too. But if you turn a blind eye, you're probably gonna get lost in the shuffle, because there's so many new participants coming to market, and we do talk about share class and what that might look like. I think we'll all solve for the increase in demand, but we're just going to charge for it differently. We just can't do everything for nothing. And I think that's the future of market making, liquidity providing, rebalancing, and things like that. I think you really need to be thinking about doubling the size of the ETF industry and not doubling the size of the participants that support it.
Mm-hmm.
I think to your point, I think it's smart to have conversations with your market makers now and ask, how can we partner, right? And how can we be a more effective and efficient partner to you? I agree. ETF share class is what is top of mind for us. At GTS, we do feel prepared that this is what's coming down the pipe early 2026. We are ready. I think as a whole, there will be constraints. But we also believe that there's going to be new entrants into the market in the market making community. So we may not be the few in between. Obviously, there's a lot more than us on the stage today. We just think that number is going to grow as it needs to, probably a little bit, not too much. And I don't know where Reggie is, but Reggie did say this. I will quote him, add it to my annual review though. He did say in an article in 2014 that ETF share class was going to be the realistic future, and that ETFs are going to cannibalize the mutual fund space.
Sure.
Here we are, right? I mean, Vanguard knew that, and here we are today too, where the DFA application is what many of you are looking to follow. However, we're going to have a lot of questions and conversations about capacity and also custom baskets and capacities with that as well.
True story. Reggie also in 2014 predicted that I would hit a birdie within 15 years on a par 4, and it came true.
Here you go.
Just in time.
Yeah.
All right. So in addition to the heating degree day and cooling degree day weather derivative innovation,
Of course.
yeah, I think we're just going to continue to see a proliferation of ETFs because of mutual fund share class, because of just the number of innovative ideas that are out there. It's just going to keep growing. Yes, we're seeing some ETFs come off the board, but I think groups like ours just being prepared to handle more and more ETFs as market makers. We're probably all in the hundreds right now, like to be prepared to be have 1,000 ETFs that you're making markets for every day, which is overwhelming, but building out that technology. I believe, the capacity for SIBs, as you said, on the capital market side, we're figuring that out as we speak, but it's there's going to be a lot of innovations in that space as well.
Excellent. Josh?
And I think what some people take for granted is like you can't just like spin up an ETF market maker overnight. It requires, in some case, years and in some case, decades of expertise and human power and technologists to build that out properly. Which is why, in a lot of cases, like a lot of the large investment banks aren't involved in a lead market making capacity. So I think what you'll increasingly see more of is firms like ours who have that kind of ETF DNA tack on additional asset classes and support for the ETF in a lot of different ways. We have the core ETF franchise that sort of keeps the lights on for us and is how we have initially kind of grown our firms. But adding on additional services in which we do to service the ETF community is probably like a trend that you'll see over the next handful of years.
I agree. I think expanding capacity within all of our firms is top of mind. The one thing that we forgot to mention is I think there's going to also be a rise still in conversions, not just thinking about ETF share class and having that be it. There's been 120 conversions
Mhm.
in the last year and some change, and so we thinking more so about mutual fund conversions sometimes can be more advantageous based on the mutual fund to convert completely.
And the 351 exchange.
Correct.
Which are
Yeah.
going to grow.
So it seems like a lot of new innovation, but also at the same time, as Chris mentioned, same type of thing that we've been expecting for 10 plus years. One major trend, Josh, I'm wondering if you could talk about this a little bit, that I'd be remiss to talk about. Cantor is heavily involved in the digital space, selfless plug, is how the growth of digital and how the growth of whether it's Bitcoin or native cryptocurrency in any way, shape, form is really involving in an ETF wrapper.
Yeah, so Flow Traders has been involved in the digital asset space since 2018, and that was initially from just kind of a proprietary market making perspective. But now we've kind of added it on to kind of our core functionality. So we're providing liquidity out of our Europe entity in plenty of different coins and the derivatives market, supporting all the ETPs. We have a venture arm that's kind of making strategic investments in some of these kind of DeFi-ish companies that are growing in the space. It started out as like one of those kind of ancillary desks that were on that were kind of tacked on to our business model and have like slowly evolved to kind of like a core pillar that we focus on at Flow Traders.
Anyone else thinking about digital in unique ways? Yeah.
Not me. It's above my pay grade, but they're going to stop making the penny. And there's a couple 100 billion pennies out there. So I'm waiting who's going to do the physical penny ETF and, have everyone going out there.
All right. Well, with that, how about we open up for questions from the floor? Anyone out there that would like to ask first question, please?
Really, all you guys. I believe in the most recent JEPI quarterly roll. Excuse me. This is for Ethan and everyone else as well. But I believe in the most recent JEPI quarterly roll, the market making community was pinned in a short gamma hole, and there was a lot of market vacillation in S&P 500 kind of as we came into expiration there. Is there a concern either as a market maker or really for the industry that we get so big, and you mentioned these monthly defined outcome ETFs, is there a concern that we get to a capacity where the market's behavior and the underlying is just so erratic that we should do something about it or think about what capacity, the market making community can take down?
Yeah, I think for the S&P 500 based ETFs and the Qs, and I think there's plenty of capacity out there at the moment. Like I'm not worried about that at all. It's more that as these products start moving towards less liquid underlyings, that I think it will see some more capacity issues arise, and that could be from the market makers of the underlying basket as those roles are taking place. The thing you're referring to in particular was I think was via swap, and what that swap dealer did with regards to the hedging and what they is I can speculate what it was, but that was not something that was done directly in the market making community. But again, I don't view this as a current problem. Like I think the S&P market is huge. Okay, and these products are. I mean, we're in the 60, 70 billion, I think now in the defined outcome. That's still a very small amount of the total S&P marketplace, but it's going to grow, and it's something we just be aware of.
And Naomi mentioned something about some of your strategies might allow for flex options. Doesn't mean you have to use them. I would advise, if you think you're going to have great success in a product that there might be issues about trading everything on one day, or disruption in the market, capacity at the close, you might want to think and talk to your lawyers and your advisors about building in flexibility about how you implement changes to your portfolio. Instead of, I mean, look, predictability can be a friend and it can be a curse. Uh, we all know the big index days, on quarterly expiration and things like that. And there's a tremendous amount of liquidity on those days. And issuers generally like to capture that liquidity and take advantage of it. But sometimes it doesn't always work that way. And so if you have the ability to say, look, I've got 8 days of trading I need to do in these handful of names. By rule, I'm supposed to do them all on one day at the close. You have to be creative about how you're going to approach that. Otherwise, you're probably going to wind up with an outcome that you would have liked to try to avoid. I don't have the answer. I'm just saying, if you're creative in what's allowed in your fund structure, can you trade over multiple days? Can you deviate from the NAV up to a below or above a certain amount? Can your holdings, shift a little bit from the strategy for a short period of time? Things like that, maybe things you want to bring to the table to help you navigate those trading scenarios that are otherwise going to wind up being hectic, I guess.
Exactly right. And just communicate, right? Communicate with the trading desk, with whoever's doing your execution, whoever in the capital market space who's involved with your ETF. Just ask questions. We will, we're a partner, and we'll give our advice of like how to do it to have the least dislocation, the least market impact, et cetera.
And keep in mind, we talk about cost of balance sheet, and we brought it up now 6 or 7 times. The highest cost is on those quarterly expirations. It's on those biggest index event days. That's when balance sheet costs the most money, because that's when there's the most demand. So you may want to take advantage of the liquidity, but it might cost you too much. So if you have the ability to pivot to a time when balance sheet's in a lot less demand, you might have a different outcome.
I would just echo, communicate and consult, right? So before we get into the situation where there is a problem or there's a constraint, or execution may not be the preferred execution for the end client, have that conversation with your market maker, pre-launch, but also before every roll.
Makes a ton of sense. I think we have time for 1 or 2 more questions. Any other questions from the group, from the floor?
I hear bottles popping downstairs.
I know. Feels like everyone wants a drink. Okay, well,
There's one question right
Go
here.
ahead.
How did you guys view the zero DTE products as they were rolling out?
Zero date to expiration products was the question. Like, how do we view
How
them?
did you guys view the zero DTE products as they were rolling out, and how do you view them today?
The second part of your question?
And how do you view them today?
I don't watch them as closely as when they first came out, but they were flying off the shelves. So I was pricing them up, and I was enjoying seeing how they were working and learning how they work. I don't think I'm fast enough they're so popular to be a participant in them. But yeah, I mean, I would chalk it up as a great success. I thought it was really cool to watch something novel and new come to market and have immediate demand and really good, healthy trading volume. Things were fair. There was some ARB in there. So I think market makers were pretty happy. We love seeing stuff like that. Yeah.
When I started trading in the pit, it was expiration 1 day a month, and now we have expiration every day. But it's a great tool. Some ETFs are obviously using them actively. Some ETFs, it's a zero DT option ETF, and that's all it does. But it's a great. It's an interesting tool, and I think a useful tool for the portfolio manager to use and to manage their risk. I'll tell you who doesn't like them are the lead market makers, because those trades are put on and taken and expire before the market maker even knows they were traded, because you never see it in the basket, basically. So for a product like that a portfolio manager is intending to use actively, what we recommend is just have a conversation with the market maker and just tell them in general, hey, I'm going to use these, and then they just know that there's this possibility that there could be a daily option trade that's going to impact that ETF, and it will probably widen out the market that the lead market maker is making, but at least, you won't get into that problem of
But that was part of that discovery process when it came out. It's like, how the heck, or how would we be able to stand in front of this? But it started with a conversation with the portfolio managers, with with the people who are running the fund, and saying, I need to know with granular detail how this works and how you put trades on and things like that. I mean, what's your behavior? It's the more you know about how a fund is run and operated, the better you can make a market, the better you can step in front of demand and supply. That's all we do all day long. And again, it's in the minority of the products that are out there. There's significant demand and supply, but our job is to figure out how to be there to catch it and provide it.
The more transparency in your basket, the tighter your spreads are. Yeah.
All right, with that, there was a giant red screen here, and I've been trained that red is bad. So we're going to close up shop and obviously transition everyone to drinks. Thank you very much for spending the time with us. Really appreciate it.